Hello, this is Mark. How are you today? Now, we are looking today into a case study, especially of the earnings of the US steel. You will see that we got in this example very nice profits using straddle and strangle strategies. So let's go. So per definition, a short straddle is nothing else than selling a call and a put option at the same strike and at the same expiration. So what we did is now in this case study is we sold a call and put option on the 27th during the trading day because the earnings would be announced by US Steel after the closing on that particular day. So you can see that the implied volatility was very high, and by doing now this transaction we got a credit of 1.39 by selling a call and put option more or less at the money, because the system proposes you just the next strike to the actual price. And in looking at that 139, we got a break even of 22.11 to 25.89. In other words, the stock would have to close, or needs to close, or let's say needs to open tomorrow on the 28th within that range in order to get a profit. So let's see now what was going on. Here you see now the short straddle per 28.4. It was about half an hour after opening of the stock market. Up front, I have to say that US Steel brought some, I would say, good results. The earnings were higher than expected. So the stock, as you can see, was slightly down, but not that much. But for our options, it's incredible what are the movements, because once, let's say, the news are out, the volatility drops dramatically. So in other words, our premium came really down, which actually is our idea, because we sold the option. So as a live, after maybe half an hour after the opening, those, let's say, 142 which we got by yesterday have dropped down. Maybe here now it's about 56. I add 60 because you understand 60 is more or less the price if you want to buy it. So in other words, whatever we sold at 142, we can buy in now at 60. So it passes us a really nice profit of 0.82. So far, the straddle strategy which would work completely well. Case study with a strangle, a short strangle. So to repeat again, a short strangle has the same expiration, but as you can see, have different strikes. This is actually maybe even better because it passes us a bit space between the strike, or let's say the actual price of the stock and the strike on the upper level, and here on the lower level. So as you can see, we sold a call 24, we sold a put 23, and we got a credit of around 94. Okay, here is 98, but let's say we take 94. That passes us a break even from 22.06 to 24.94. Really nice as well. You see an implied volatility of 138, and let's see now what has happened the next day. You can see the stock is now 23, so I have done maybe this print screen about half an hour after opening, and again it's just incredible how the premium of the options have decreased. So you can see now the same call is now 24, only 6 cents left, and the put 17 cents. So it passes us the profit of 0.72, meaning yesterday we got 98 as an average, and we bought in, let's say here 26, I write, that you can see here. So it would pass us an incredible profit of 72 just for one day. So the next two would be even another strategy of a strangle, but I have extended a bit the strikes. You see on the better side, whenever we have this kind of earning reports, it's recommended that maybe we extend even more the strikes of the call and the put option. Why? Is because experience shows us that a stock can really fluctuate. I mean, you see here we are 23.61. It's just in between maybe 5 minutes I did this print screen. So you can see that the break even by having now selling a call and put on the 27, it would passes us here. I write about 41, or you can say here 37 or 38 credit by selling a call and a put option, which is certainly far away. You can see the break even would be 21.63 to 25.37. So we got less premium, but I think the probability that we would be exercised are quite small. You can see here the delta, which is just 12%, and I think this reflects that it's really far away, but I have to admit that it can happen to all kind of stock. If the results would be really bad, the stock can drop by 20%. So as I said, here now we were on a good side, that we have a volatility very high, and by doing this strategy, the probability that we get into a nice profit is certainly very high. Looking at the result, well, we know already that the US steel was more or less at the same price on the 28th, and you see now the call of 25 anyway is worthless. The put is now 4 cents. So in other words, the profit what we got 41 minus the premium we would have to pay to cover those two options would be 5 or 6. So we would have a nice profit, really an incredible profit of 35. This is probably would be the best deal we would have done, in a way that we can sell the options but be on the good side, that if there's not really an incredible movement of the stock, we can really have a high probability that we can get a profit out of it. So this is the case study about US steel. This is an example to show you a little bit how are stocks moving, or let's say how the volatility is moving in earnings days. And obviously this is certainly very interesting. I have shown you now a case study by using this Strangle and Straddle. Obviously we could use earning results for credit or debit spreads as well, which certainly will be one of my next case studies. But overall, it's certainly very interesting to see how volatility is moving up front to the earning of a stock. Well, if you have any question or suggestion, if you want that I do a case study for a particular stock, just let me know, and I'm pleased to do that for you. So in the meantime, I hope you could enjoy, and you may follow some new case studies up front, or going into the option strategies as shown on the screen. Have a good time. Bye bye.